Clock. Oh, we're live.
We are live. Well, it's official. So yeah, thanks everyone for joining us on this Compound Quarterly Analyst call. Just want to let everyone know if you guys have any questions, feel free to drop them, and we'll try to address those towards the end of the call. Quick introduction: my name is Sean. We have Sami here. We're both research analysts at Messari. We're here today with Getty Hill from GFX Labs. Very kind to be joining us here again today. So thank you for that. But if you want to just give like a brief introduction of who you are, what's GFX Labs about, and kind of how you guys, fit into the puzzle of Compound.
Yeah, sure thing. Thanks for having me here. Glad to be invited back for a second time to go through the numbers here on Compound over the last quarter. So myself and GFX Labs have been involved in Compound now for definitely at least 2 years solidly. We're responsible for a lot of the fund governance stuff in the protocol, and one of the general movers and shakers on there as well. So definitely check out the other work that we're doing on in general in the space. We have Poppy, which is a neat crypto credit card product that we're developing in the game Etherlands, but we love to dabble in DeFi and governance wholeheartedly as well. So you can see our work on Compound by checking out the forum over there, or on Uniswap and whatnot as well. So we're in all places for the most part. We really enjoy participating in DeFi and the wild space of crypto.
Awesome. Yeah, thanks for that overview. So yeah, basically, the focus of this call today is really to just kind of dig into some on-chain data, get a better understanding of what happened over the quarter, and identify any changes in KPIs, some key changes to the protocol, and just kind of overall market trends. So before going into that, I just want to give everyone, maybe some new viewers, just a quick recap of what Compound is. Just a leading decentralized interest rate protocol, serving as a marketplace for, lenders and borrowers of various assets. And before digging into the macro, I kind of want to just give like a quick, crypto market backdrop. Generally, the overall crypto market in Q4 hit all-time highs, which largely drove a lot of the activity in the previous quarter. And as we rolled into Q1, we saw some volatility, kind of shaving off some couple, 1.4 trillion off the peak back in Q4 to around 1.6 trillion in Q1. Kind of revisiting those 12-month lows. Back what we saw back in July of 2021. So just, I think as we understand that a little better, it'll kind of help drive and appreciate the narrative of the overall Compound sentiment over the last quarter. So, it appears leverage kind of increases as the markets kind of experience bull cycles. So, as we mentioned, the market cooled down in Q1. And I feel like that's a really good segue into kind of going over some of these macro metrics for Compound. I'm going to share my screen here, so bear with me. We all good here? Awesome. So yeah, you'll see, outstanding loans and deposits are really the driving factors of Compound. And as you can see, we saw a pretty substantial decrease across all indicators here. We saw about a 42% decrease in outstanding loans, coming from about 6 billion to about 3.5 billion. And largely driven by the borrower appetite, the demand for leverage just decreasing in Q1. And going down, outstanding deposits dropped about 32%, coming from 14 billion to just shy of 10 billion. And, originations also took a pretty big hit, just over 50%, going from 11 billion to just under 6 billion. And, subsequently deposits also were down about 80%, pretty nasty metric there. But yeah, we saw 63 billion last quarter, drop to about 13 billion and change this quarter. Really the only metrics that really saw any light were liquidations, but at the same time, probably not favorable for most of the users of the protocol. I mean, we saw about almost a 300% increase in liquidations from about 34 million to 134 million. I think that was mostly driven by the wrapped ETH markets on Compound. But just kind of digging a little deeper into the net interest income, or the financials, I should say. Total interest income was kind of slashed by about 50%, from 90 million in Q4 to just under 42 million. And as the loan demand decreased, depositor demand kind of decreased, which ultimately decreased interest expense from about 80 million to about 37 million, giving us just shy of 5 million in net interest income. And Q1 there was a pause in the grants program, so there weren't any grants paid, so we really just have an unchanged net income amount of 4.8 million. So going a little further down, we have the token incentives paid. Similarly, the loans outstanding, deposits outstanding declining. We'll definitely see a decline across the token incentives being paid. So that fell from 55 million to about 26 million over the quarter, and really giving us an adjusted net income improvement of about 53%, ending about negative 22 million in the quarter. So that was a lot of data kind of thrown at you. So hope you were able to kind of digest some of that. Kind of wanted to ask you, Getty, if you have any overall kind of broad input on some of those changes over the quarter.
Yeah, I think it definitely wasn't by no means the strong quarter for Compound. I think similar though, like it was a tough one in general for like many platforms in DeFi. So it's not exactly Compound acting as an anomaly in this stance. I think generally speaking, kind of some of the key external inputs in the space that are really strong indicators to like what the health of the ecosystem is kind of shown over the last quarter or so. Definitely like a slow. I mean, I noticed the other day that like Tether had its last print on April 3rd, and in February, in late February was the last USDC mint. So things that for the most part still in Q4 and certainly in Q3 were just chugging along, printing huge amounts of new dollars and value into the space have substantially contracted. So I think like those are interesting indicators to like say, okay, maybe there's some like reason, external reason behind the shrinking growth in the platform over the last quarter. I do want to highlight, I think one of the most important line items on this page here is that aggregate utilization. After all, the protocol's job is to take in assets that folks lend to the protocol and then lend assets out to borrowers. And that's a key stat to me on here. It's a bit hard to say when you see outstanding loans in terms of a dollar value adjusting because there's all these coin prices and whatnot. Aggregate utilization is an important one because of that. So it's disappointing to see that it is down, but when relatively compared to kind of some of those other stats there that are showing a 41% shrink in outstanding loans and a 32% shrink in deposits, I think it becomes a lot more a lot easier to stomach when you understand that, okay, the general bread and butter of the protocol here, sure, it shrunk, but it really shrunk by like less than 6% over the last quarter. And that's the key component for me.
Yeah, great. Thank you for that input. Sami, did you have anything?
No, yeah, I think Getty just made a good point related to how a lot of the decreases aren't a direct relation to just specifically Compound. It's mainly related to just the general financial market that we're seeing going on in the crypto space. We had general market conditions just trading sideways, and so a lack of users looking for leverage is essentially going to lead to a lack of borrowing activity. Pretty straightforward here.
Yeah. Getty, quick question. I feel like these metrics are pretty easy to follow. Is there anything outside of this that you typically look at? And maybe does it change as the overall market sentiment changes? Whether we're more of a bull cycle, more of a bearish cycle. Are there different indicators that you're kind of keeping track of?
I think there's some specific users that you can look at that demonstrate a good wind vein essentially for the flow of funds in the space. Whether if you look at some of these monster accounts, I mean, if you especially want to figure out who the big users are on the platform and track what they're doing and say, hey, these guys are sophisticated. They're on Aave, they're on MakerDAO, they're on Compound, they're on all the money markets, they're on even cross chains platforms. Where are they putting their capital? How is their capital flowing? Those users are the ones I tend to look at when we want to get a bit more of a specific sample as to what's happening. There's one of the reasons why Compound is what it is today is that there is a lot of users who used it once upon a time, a year ago, 2 years ago, and it's never left. And that makes it for a little harder to look at the whole picture and get a macro sense of what exists here and what's actually occurring in the trend. If you look at some of those particular target users who have a few $100 million position on Compound, but also on Aave and also on MakerDAO, they paint a better picture of exactly why users are flowing capital from point A to B. Is it because MakerDAO is reducing their interest rates and providing a more capital efficient opportunity for those users? Is it because that Aave is offering some new assets that have a collective better overall margin, account margin opportunity for those users? Those are, I think, the details that you can't necessarily encompass in a macro overview like this that can paint a bit more of a precise picture.
No, yeah, I totally agree with that comment. And yeah, we might just kind of high level touch on something similar to what you were saying as it relates to, the more sophisticated, deeper liquidity folks who are participating on the platform. But yeah, so, moving along, Sami, I'll let you take over here. But yeah, we're going to just kind of go over some of the charts as it relates to these outstanding loans and deposits. And I'll let you take care of that, Sami.
Yeah, I appreciate that. So starting off here with outstanding loans. In general, we saw outstanding loans decline by roughly 42%, like Sean was saying. So these levels are going back to what we saw in around July of 2021. And again, like we discussed, this is mainly related to market conditions, just trading very choppy for the past quarter. We really haven't seen any new highs like we saw in Q4. So just a lot of volatility up and down, which is what you see in a sideways traded market. So the biggest contributors that we have to outstanding loans are obviously the stable coins. And that's where we saw the biggest decrease in. So we had DAI, which decreased roughly 47% this quarter. And USD decreased roughly 41% this quarter as far as outstanding loans. Now, if we go to the next chart here, we can kind of take a look at the borrower interest rates. And in general, last quarter, these rates were averaging at about 5% in Q4. Now, for this quarter, Q1, we saw rates averaging at about 3.8%. So a pretty substantial drop in borrower interest rates. One thing I found that was interesting is ever since Q3, you're kind of seeing a minimization of just volatility in general for borrower interest rates. And that's kind of excluding what we saw in October and November of 2021. And we kind of saw the volatility there tick up mainly around when the market was peaking as far as just general market cap. So one thing I wanted to ask you, Getty, is the majority of borrowing demand on Compound we know is originating from people looking for leverage and also people seeking out yield farming opportunities. And that's really because DeFi is in its state right now more of a circular economy. It doesn't really feed into too much real world applications. And so I was curious if you had any views on where you saw maybe future new demand, new borrowing demand originating from. Do you have any thoughts on that?
Yeah, I think, in the immediate future, there are a number of collateral assets the platform is looking to support, and I think those will be like the most immediate things to drive bar demand. Like particularly something that GFX Labs has been working on is getting Matic added to the platform, or Polygon's native currency. I think there's like a huge amount of interest in getting that supported on somewhere on mainnet, because currently it's not actually available to borrow against anywhere on mainnet in size at least. So I think that's on the immediate forefront. And then from there, I think, on the longer term view, it looks like the industry is still extremely nascent in the whole sense. I don't think necessarily external motives from the traditional world are going to be influencing the platform anytime soon. But I do think as we look to expand beyond just basic ERC20 tokens as collateral and some more sophisticated positions, that new opportunities will rise to the platform. People have been talking about getting STETH added to the platform, which has been quite popular, or other versions of staked ETH, and then from there, other derivatives, some of these AMM LP tokens and whatnot that you can safely assign collateral values to. So it's a matter of time and building out the infrastructure for those components, but I think that's what will be drawing borrowers in over the long term.
Yeah, that makes sense. And then when we think longer term as well, once Compound goes multi-chain, that'll definitely kind of bring new borrowing activity as well onto the protocol.
Yeah, absolutely. Those new chains will be really, really important. It's something that Aave has done, massively well on. It is succeeding in onboarding new assets on those chains, and it's just something we have to play catch up on at this point.
Yeah. So another question I wanted to bounce your way is related to recursive borrowing. So for the viewers here that don't know what that is, can you kind of give an overview of what recursive borrowing is? And then also just kind of provide like your view on whether that has like a positive impact on the protocol, or if it's more of like a negative or frowned upon impact.
Sure thing. So, there's two particular users on Compound, right? There's the users who supply capital because they're interested in borrowing some other assets. So they supply one coin, borrow a different coin. Then there are the other users who just supply capital to the protocol in an interest to like earn yield. Now within those like that, there's a subcategory of there are users who just traditionally supply, whatever given asset to the protocol. And then there are these recursive participants. So some just supply, some put on this bit more sophisticated of a strategy where you will borrow, or you'll just deposit collateral, say DAI, for example, here, and you'll have 100,000 DAI, and then you can go and borrow up to your maximum, whatever the collateral factor is against DAI on the market, and borrow the maximum of it. You take now everything you just borrowed, you deposit it back into the protocol, and you repeat this process over and again to get that recursiveness. Essentially what it does is it amplifies your dollar notional position on the platform while maintaining the same amount of capital that you're investing into the position. Why people do this is because at times, because we're incentivizing participation in the protocol through comp rewards, comp is getting paid to the pro rata share of participants on the supply side, and then the pro rata participation on the borrow side. And so users can amplify their pro rata participation in this pool by doing this recursive kind of setup here. So I think that's like the quick overview of what it is. This has been going on now we're coming up on 2 years. It's been going on for a long time. And there is been some recent debate about how sustainable, how important are these for the platform, and what they actually mean for the platform. What all that is happening here from a purely stats standpoint, the user's depositing capital, and the interest rates will largely remain unchanged, and the utilization of the protocol remains unchanged regardless of if this user is a traditional supplier of the protocol and just lending that capital or recursively borrowing it. The amount of capital getting deposited is the same. It doesn't affect the change in utilization because they're just perfectly looping it through. So in general, its actual only change in the protocol is changing TVL a little bit, changing interest rates a little bit. It doesn't really provide significant capital to the protocol in any means beyond just a general supply. Essentially these things function identical to what a normal lender would do to the protocol. The only difference is that they're amplifying their these stats because there are some other other reasons that make the stats bigger. But for the most part, they just function like any other loan to the protocol.
Gotcha. Yeah. So it sounds like it's not adding any additional risk to the protocol. And so essentially they're just like farming out these comp rewards, right? And so if we ended up seeing in the future at some point these comp rewards kind of being removed from the market, would you essentially see these recursive borrowers leave as well?
Yeah, I don't think they would necessarily leave, but I definitely think there'd be a decrease. Essentially, what's happening right now is the protocol is subsidizing rates just to make up a number. If the protocol is paying out 3% interest rates, and the comp rewards add an additional 25 or 50 bips to the protocol, hey, that's 25 or 50 bips. And in theory, if we pull those out, then some capital should drift away from the protocol to better opportunities. But the core premise that folks need to remember is that these guys are looping because they're interested in getting the best interest rate available. That like their job is to make money ultimately. And so if we decrease our rates further by removing this extra incentive, but we remain to be the best option for their capital will stay. So I don't think we would lose like 100% of capital that's relying on these rates, because at the same time the general problem exists at Aave as well, many of their alternatives to where they can stick their capital. And at this point, the rates have been on a solid trend down for, since the very day they started, but particularly in the last half a year or so. You could look back, to even 5-6 months ago, or, at the very beginning of the year, you could still earn like 12% doing a recursive loan on DAI, which most would view to be a very safe, stable rate to be earning on capital. And today it's substantially less than that. So I think we've already seen a solid progression of those rewards decrease, and of that participation decrease along with it.
Perfect. Yeah, I really appreciate you breaking that down. So let's go ahead and move on to the next slide, where we'll talk a little bit about outstanding deposits in general. So Wrapped Ethereum continues to maintain its dominance as like the largest deposit asset on the protocol. This quarter, we saw DAI and USDC kind of neck and neck competing for that second largest deposit. They're very close as far as actual dollar amounts. The interesting thing is that we saw DAI's outstanding deposits decrease nearly 50%. And then if we look at deposit volume for DAI on the quarter, that was down 90%. And Sean was actually pretty curious in why like this DAI deposit volume had decreased so much. And so he worked with one of our data scientists here, and they were kind of looking at the on-chain metrics, and they were suggesting mainly that there were a few market makers that were basically like arbitraging between Aave and Compound, just kind of like you said, looking for the best interest rates. And so it seems like they closed out some pretty large positions in Q1. And that goes back to what you were saying in the beginning of looking at the macro. Doesn't really tell you the whole story. Kind of looking at some of these whales and some of these users of the protocol also gives you like additional insight for what's going on the protocol. One thing that got me curious as well. So last quarter, we saw Coinbase's DeFi yield integration. So essentially, if you had DAI, they would pay you an interest rate, and essentially they were taking that DAI and then inserting it into Compound. And so last quarter, we saw a large inflow of DAI. And it seems that this quarter, we saw a 50% reduction, right? So it makes me think like, did we get kind of just like a little bump in outstanding deposits from that integration, and then like long term that wasn't really sustainable? It just depleted slowly. And it makes me think, because or the protocol has MakerDAO's like DAI direct deposit module coming up, which is essentially going to do something similar. So I just kind of wanted to get your view on, do you think these integrations with like different products kind of have like a long-term effect on the protocol, or is it sometimes just like short-term,
Yeah, I think it's tough to say. We don't really have a long history to really go off of, or any history of like protocol integrations materially changing the landscape of what the platform looks like. I'm really excited for the D3M module, though, MakerDAO's direct deposit module to come about. I think that's a really efficient way for the protocol to get capital, and also, symbiotically work with MakerDAO and kind of an uncompetitive environment where everyone wins. So I'm very much looking forward to that. I do think that though it's a bit hard to say, what it all looks like. There's a strict balance in my mind as a bit more of a traditional DeFi person that protocol integrations are great as long as you don't add on too much systemic risk to the space, because ultimately some of the game that folks are playing with Compound is say, well, Compound's in a great position to succeed if Aave explodes one day, God forbid it ever happens, and vice versa. And so everyone needs to make sure we also don't, we don't stack on too much systemic risk in the space, which, could, lend to the demise of something truly awful were to happen.
Yeah. Moving on to depositor interest rates in general, we saw rates decrease just as borrowing demand declined over the last quarter. So Q4, we had the average rate for depositing be around 2%. This quarter is around 1.5% on average. One thing interesting to note is that we are seeing just the normal depositor interest rate and then the depositor interest rate with incentives start to converge, not only for depositing, but borrowers. And this is partially attributed to comp, basically halving the comp rewards. And I'm sure we'll talk about that quite a bit in later on. So I'll just kind of mention that for now. But kind of related to all these new integrations, I have another question for you. Do you see kind of like the main source of deposits on Compound in the future coming from like these professional liquidity providers, whether it's like funds, VCs, institutions? Is that kind of what the protocol is targeting rather than just like the normal DeFi user? This might be like a general DeFi question. Like, are these protocols starting to focus more on institutions that have more deep liquidity rather than the person who's just yield farming in their mom's basement?
Yeah, well, I think we need to keep in mind when we're talking about depositor rates, we're largely thinking about the stable coins on the protocol, DAI, USDC, Tether, and I think largely speaking, the folks who are leaning on those markets the most, representing the largest portion of those markets, are I think institutional players or players with extreme high net worths who are looking to park dollars for safe, steady rates for a long period of time. I know for certain that some of the larger participants in the bar lend ecosystem in crypto, like the BlockFis, the Celsiuses, the Nexos of the space, certainly look at general dollar rates. And the primary stat historically in crypto for dollar rates has been the funding on the Bitcoin perp. But certainly DeFi dollar rates are creeping into the methodology as well as like, hey, how much can my dollars earn and where can I put them? We're slowly developing a bit of our own DeFi based LIBOR across all the ecosystems.
Yeah, that makes sense. Thanks for breaking that down. Last slide that I'll be covering right now is going to be the utilization ratio. If we can go to that slide, Sean. Yeah, this slide basically just summarizes what we've been saying. There's basically the outstanding borrows have just decreased in relation to outstanding deposits. The only interesting thing I can comment about this is that historically we've seen 40% almost serve as sort of like a support level, and we haven't seen that rate drop below 40% for like a significant period of time. But Q1, we have seen it fall below 40% for an extended period of time. So I think that pretty much just wraps it up here. I'll pass it back to you, Sean, to take over the next few slides.
Cool. Thank you. Yeah, so I mean, we touched base on this a little bit earlier in that kind of macro table as it relates to interest income. Obviously, as you can see, there's a substantial decrease quarter over quarter. I think it was about 53% decline from 90 million to 42 million in interest. And, it's just directly correlated with the overall demand for loans, repayment on those loans, interest that, essentially flows through the protocol. But one thing I wanted to just mention is looking at the data, it looks like USDC actually led the way in kind of the deterioration in interest income. Counts for about 62% decline, with USDT and WBTC kind of fighting for second in interest income deterioration with like 50.8 and 50.7%, respectively. And moving on to protocol income, the narrative is very much the same across the board outside of liquidations, but protocol income, same thing, was halved in Q1, a little over 50%. And same thing, USDC kind of led that reduction in income. I'd be curious, Getty, if, I know there have been previous conversations related to improvement in protocol income, how important it is to the overall compound protocol and community at large. Instead of me talking about some of these points, I'd be interested in hearing maybe some high-level remarks about what could contribute to the improvement of protocol revenue, and maybe how far we might be away from some of those implementations.
Yeah. So I think, I'll preface it with, let's keep in mind compound governance has been around for like less than a year and a half at this point. So we're the folks where everyone's still learning it and how the best to organize and everything. But that being said, the reserve factor is what determines how much the protocol takes from interest paid by borrowers before it reaches the lenders. That number is like a set parameter on every single market on the platform. And generally speaking, stable coins have a much lower one. Altcoins have a much higher one, particularly when we're talking about the big income earners for the protocol. We're thinking about DAI, USDC, Tether. Now, USDC and Tether both have a 7% reserve factor, which means we get 7% of interest paid from the borrowers there, whereas DAI notably has 15%, which means I think the thought was like this thing's a bit more volatile, it'll take a bit more when it was originally set. That being said, though, back to my original governance comment here, the protocol hasn't really done much to play around with these, do any type of research really about, hey, should we be choosing a higher or lower number? And so we have rather limited data to actually say what should we be doing. And the protocol needs to get into a spot where we're willing to experiment a bit more with those rates to actually understand how income can be optimized for the protocol and take those revenues to something a bit more sustainable than what we're currently at today. So it's a bit of a complex problem that just generally needs a bit more time and testing before we can really speak to it. And hopefully that's something we get to start doing here in the near future.
Sure. Yeah. And it seems recently I was kind of scouring the forums, and it looks like there's been mention of kind of building out like an asset onboarding kind of framework as it relates to why we should onboard a specific asset. I mean, I understand demand would be a very critical factor in that, but maybe if you can kind of touch base on any input you might have on that, and how you think that would kind of move forward.
Yeah, that's a bit of a long point, so I'll try to keep it brief here, since to not brick the rest of the deck here that I know we have. But that when it comes to listing assets, you really have to think about it in a few different categories, or at least 3 different points you need to assess. One is the general interest in for folks to be supplying that as collateral. Folks interested in actually borrowing this collateral. So one of those 2 things needs to be substantially true for the protocol to even really assess it. From there, it becomes the security risk and understanding that. A lot of the assets that folks are interested in adding to the platform right now, other than Matic, are like Frax, LUSD, and RAI, which generally speaking are a bit outside the normal range of where the protocol operates, especially in far of the complexity and risk spectrum when it comes to asset listings. And so it's a delicate balance of we want to add things to the protocol that users are interested and want, and we don't want to stack on too much protocol risk, because not to be dramatic, but if we list an asset and we give it a collateral factor and it has some type of error in it, that can, the classic example is the Infinite. then all the funds in the protocol could be drained if that thing has like infinite, has any collateral factor greater than 0. And so the protocol tends to be quite conservative with, listing new assets, especially because when you look at the stats as we are here, wrap Bitcoin, ETH, DAI, USDC, the protocol would be not too different if we didn't have any of these other assets on the protocol. I mean, when we going through the spreadsheet, if you just imagine we only have those 4 coins, it would be largely the same stuff that we're talking about. So you really have to be careful about the marginal, improvement by adding a new asset.
Yeah, no, that's great. Sami, I don't know if you had any questions or input on that.
No, I just think that's a great point that Getty made. It's really just stables that have the majority of borrowing demand, and it kind of goes back to the multi-chain approach that is being talked about just having like one collateral asset and it just being or one deposit asset, I believe, which is just going to be USDC, right? Which we'll be talking more about that multi-chain approach as we get towards the end of this slide deck.
So yeah, I'll pass it back to you, Sami, as it relates to liquidations.
Yeah, so like you pointed out, Sean, in the beginning, I mean, liquidations was one of the only metrics that kind of had a good quarter. So we saw a substantial increase in liquidations. Question to toss your way, Getty. Can you just give some thoughts on like liquidation revenue's importance to the protocol? Like, do we see this as like healthy revenue?
It's definitely, I think this is a newer thing. So it's rather not recent, but in like, I think mid 2021, we changed the liquidation system to split part of the liquidator incentive. So historically there's been about, I think it was like 7 or 8% that was distributed to the liquidator. And then the protocol is like, we're going to keep like 3 of that for ourselves, and we're going to give 5 of that to the liquidator now. This is something similar to MakerDAO does. They get some revenue from liquidations as well as, I believe, Aave, but I could be wrong on that one. And so, it's a weird one. In my personal opinion is that protocol shouldn't be incentivized to have liquidations. The inverse of that opinion, to play devil's advocate quickly, is just simply that, the protocol is taking out risk here. You should be similarly compensated for that loan. And my opinion is that, that risk, comes in the factor of the interest rate and that reserve factor we were talking about before. But I think it's, it's a good thing to be experimenting with, especially in grand days. We all have to remember, as I get stuck in the trenches of DeFi quite often, that really, we've only been around for like 2 years. So there's a lot to be learned and experimented with.
Yeah, exactly. So moving on to the next slide here, we're going to have just a chart on token incentives paid. And I guess this is where we can talk a little bit about some of these governance proposals that have been passed. So one of the most critical or kind of major governance proposals that we saw pass this quarter was, I think it was Prop 92, which basically reduced comp rewards paid out by 50%. Now, this seemed to be like a pretty heated discussion as far as in the forums. There seemed to be people on both sides, and I guess the plan was to kind of slowly step down to like 0 rewards, and I think Prop 100 aimed to do that. But recently, I believe 2 days ago, we saw Prop 100 fail, and so what is the plan? I know the community has to really talk about this, but as of right now, we're just kind of sitting at 50% rewards, right? Is there a plan that the community is talking about? Is there a reason why like this first proposal went through and now all of a sudden it seems like the community might have changed their mind? Because I believe it was outlined how initially you guys were going to step down to like 50% and then eventually to 0. So can you talk a little bit through maybe like both sides of the argument related to removing rewards versus keeping them?
So there is first I want to like set the stage a bit and say, like, when we think about rewards and how they're distributed to the to like users of the protocol, we need to think about them in token terms and in dollar terms. Now, ultimately, we're assuming that the folks who are interested in these rewards the most are here for the financial incentives that these guys are running and interested in money. And so ultimately for their experience, all they care about is the dollar notional, the dollar notional value of these tokens that are coming to them. From the protocol's perspective, we probably care about the dollar notional value of those tokens, but we also care about the general number of tokens, as we're essentially entering new tokens into the supply, the circulating supply, and diluting all the existing comp holders. So it's a bit of a difference there that I want to highlight. So if we look over the last year or so, certainly in the last 8 months, as comp prices declined, with generally the rest of the the DeFi ecosystem, those dollar notional rewards that we're distributing to users has kind of declined itself from the people who are interested in using the protocol's perspective. Rewards have already been cut, right? The inverse of that would be for us to maintain a dollar value and increase the notional amount of comp that we're distributing to maintain the actual dollar notional rewards that they're achieving. But that's not the case. So from their perspective, hey, these things have already been going down for a while. And that's what they're used to, and we already have a lot of data to support what those users are going to be doing as those rates decrease across the not only compound but the blanket of DeFi. Now, particularly with the most recent 92 and 100 proposal, I think everyone is on the same page of like, yep, these rewards aren't sustainable for the most part. And I shouldn't say everyone, but like there's certainly some agreement around like these aren't sustainable. These need to be reformed. And I think that's why 92 was a bit more like easy to stomach. It was just a general, we're going to cut these in half. It was quite clearly cited in 92 that there was going to be a proposal 100 that was going to cut them to zero. I think folks largely either didn't read that or we're just gonna like, all right, well, we'll deal with that problem when we get to it. And so 92 was rather like not controversial for the most part. Folks kind of just voted not supported. It seemed pretty straightforward. The folks who I think represent the protocol most aptly understand that that was a good decision. And then 100 ended up being extremely controversial. I mean, I think I haven't gone through the data because there is 100 proposals at this point to go through, but I think it is the most controversial governance proposal that has occurred on Compound, and certainly one of the most controversial ones in DeFi in general, in the sense that we had, for our protocol, a very good voter turnout, about 500,000 on each side, and it came down to 7,000 votes, which really, when you go down the list of people who are set up to vote in the protocol, it was a pretty good population of folks who actually turned out to vote. There's a number of people who I was disappointed not to see, but it was relatively good. Disappointing outcome from my perspective, because I really think rewards at this point are doing very little to support the system and largely just hurting existing comp holders like myself. But that's the plight of governance.
Yeah, I just think it's really interesting how basically depending on how you interact with the protocol leads to like how you would view this decision, right? So like if you're a big whale that would be using this protocol, obviously it's not in your incentives to want some of these rewards to be removed. But if you are a VC or a contributor or just simply a holder, it's in your best interest to one, have these rewards eventually go to zero, because you're not getting crowded out anymore. You're not getting devalued essentially. So it's really interesting to see everybody in the community kind of like put their opinion in. Like you said, I mean, the forum post was just popping with everybody. I think it was personally, I think it was the one I've seen with the most comments. And like you said, that 7,000 vote delta was extremely close. Anything to add to that, Sean?
Not a whole lot, but I mean, as an observer, I'm not a participant of the protocol. It makes a lot of sense from a sustainability point of view. Plenty of like mercenary capital that's just really soaking up all the rewards, dumping the tokens, applying sell side pressure on the comp token price, and like it makes sense that this isn't sustainable long term, and making those steps, strategic steps to try to keep everyone on the same page, keep everyone happy, but also maintain the health of the protocol. So definitely in agreement with the conversation there.
I'll add a quick tidbit there. So while this proposal was going on, I was doing some quick research to figure out, what for someone, how many of these comp rewards are roughly going to folks who are just immediately selling the token. And it was like, what are the recursive participants? Because generally those are the folks who are doing it, and what are they immediately doing, et cetera. And if you just alone look at the top 10 suppliers of USDC to the protocol, at the top 10 suppliers of DAI to the protocol, and you only look at those accounts, DAI and USDC alone account for over about 77% of total comp rewards distributed in the program now. So largely those two alone account for pretty much everything. And then from there, you can look at these users and see what their activity is and what they're doing. You can account with, like, right there between all of them, that they represent these recursive users who are just here simply with mercenary capital, which is fine. I'm totally fine with that. And get the comp and then just immediately sell the comp. That accounts for alone about 41% of the comp rewards getting distributed. And that's just the sample of the top 10 users on those two markets alone, with very particular, like, I was trying to get some quick data in 30 minutes together. That's what I quickly found. I was like, well, if it's 41% with just this set, the number is definitely a fair bit higher. And that to me is the part that's just all we're getting out of this is a little more capital in the protocol and a higher TVL number. And, for what, to continue deleting all the existing holders and, accepting kind of mediocrity on this program. It's to me, it's a pretty black and white issue that I did not, expect to be so controversial in Proposal 100.
Yeah, no, that you bring up a lot of good points, and it's not that we don't want participants on Compound, but we also need to kind of create a healthy floor and stabilize the overall protocol. So, kind of shaking out some of the mercenary capital by removing some of those incentives, makes sense.
Yeah, I mean, we have a great user base. I mean, you guys have the data here to show that there is billions of dollars of regular natural usage of the protocol, folks who are supplying Ethernet, Bitcoin, and borrowing dollars for the core example of leverage on their assets. This program that we have here to distribute incentives, best case is adding 1.5 billion, really best case is adding 1.5 billion, most likely adding somewhere between about 650 million, 800 million to the protocol. It's not significant to the actual day-to-day operations of the protocol or fundamentally change anything about the protocol. It's really just, in my mind, a leech on the protocol at this point. We were doing, Compound existed well before comp incentives ever existed, and it proved that it had a natural use case in the market. And the data still supports it does today. So it's just can we get rid of this thing already, please?
Yeah, no, that makes a lot of sense. As I said, as an observer, just kind of looking at it purely from a data perspective, and then just hearing input from the community and yourself, overall, you just want an attractive protocol that's sustainable, that's healthy, that promotes growth and encourages users. So it is a step in the right direction. So I'll be curious to see how the next proposal that might try bringing the emissions down to zero will go. But as we kind of move forward, we touched on deposit volume a little bit. 80% decline over the quarter, 63 million to 13 million in deposits. Substantial, actually, maybe, sorry, 63. Yeah, 63. And DAI accounted for a lot of that. And as Sami was mentioning, me and another couple folks were kind of digging into some on-chain data. And it looks like, it's exclusive to a few market makers that were really trying to arbitrage between Aave and Compound early or sometime in Q4. And it was just really, not only is it super cool to see the on-chain data to kind of make those suggestions, but it's also interesting to see that's really what drove a lot of the quarterly deposit volume. And then, also towards as we entered Q1, looks like maybe a separate market maker was basically redeeming their funds from the protocol, maybe in preparation for the reduction of comp emissions towards the end of Q1. So yeah, just really interesting to see as you just look at the chart. It's a pretty glaring drop in quarterly volume. And then, yeah, as we kind of wrap up here, at least as it relates to charts, originations, same story. Demand for loans declined. Demand for new loans will follow. Yeah, so seeing a 53% drop from 11 billion to, or sorry, 11 million to 5 million. 11 billion to 5 billion. And what I thought was interesting is just like 4 consecutive quarters of the declining originations. And I think that's largely related to the overall market sentiment. But we might be curious if you have any kind of input or future outlook of originations kind of moving forward.
Stats like volume and originations are a bit hard to kind of nail down, just because it's DeFi and capital is just extremely liquid. If folks want to leave and join the protocol for an instant, they are welcome to do so with no penalty. So that makes these stats kind of like hard to focus on. That goes back to like the very first slide where I was like, the thing to really care about is that utilization number. So like for me, like that's the number I focus on, less so the originations and volume stats.
Perfect sense to me. Yeah, I mean, like you said, you could easily throw a billion in, take a billion out inside of a day, and it still contributes to, originations or deposit volume on a quarterly basis. So
exactly,
that makes a lot of sense. So yeah, kind of moving on into kind of governance. It looks like there's about 8 proposals that were passed in the quarter. Won't touch base on all of them, but I'd say there were a few that were pretty critical to the overall, critical changes to the protocol. Sami, did you want to kind of take a stab at those?
Yeah, so we talked about 2 of the really important ones, Prop 92, Prop 100. I guess one of the other ones I found interesting was Prop 89, and that really was just reducing the proposal threshold from 65K comp to 25K comp, which I think, is important just to kind of stimulate further activity into the governance system. One thing I thought that was interesting was that we really didn't see that many voters in Prop 100, even though it might have been one of the more popular propositions or governance proposals. I think there were a total of 48 addresses. So Getty, personally, have you seen that trying to get people to contribute to some of these governance proposals has been difficult?
It's not so much the number for me as so is just the amount of comp that shows up to vote. Right, these systems aren't democracies. We run on a plutocracy system here where it's based off of capital rather than just who's present. And so for me, it's what is the comp turnout in these things? The comp turnout was decent. It was pretty on par with the other significant proposals we've had historically. Certainly could have been higher. I would have liked to see a number of folks turn out that didn't turn out. But I think for the most part, it wasn't disappointing as a specific proposal. In general, it'd be nice to see that we had a larger percentage of the comp turnout, to votes. We're 6 million circulating supply, 6.5 million circulating supply. To only have 1 million turnout isn't terrible, but it isn't great either. It'd be nice to have 2 million turnout for these things. As far as the number of voters go, if you just check out on the Compound website, there's great databases for this stuff. Really, once you get around to voter 50, as far as the leaderboard goes, the amount of votes really substantially drops off. A lot of these things are largely decided amongst the top 25 people, just because that's where the power is really contained as far as the number of votes and who possesses those votes.
Yeah. Any thoughts on potentially I don't know if any protocols actually do this, but incentivizing people to contribute to or just to vote in general?
I don't think the act of voting is really important. That's kind of the weird part of this. So there should be more things to vote on in general. I think that's important. That's one of the reasons why I like the idea of 89, and that there's about 3 facets right now for making, prior to 89. Well, there's about 3 facets to make a proposal right now. You either have enough votes delegated to you that you can, make the proposal. You either have the comp yourself and, the total number of coins, or you're on the whitelist, essentially a thing that the community multi-sig and governance controls the whitelist addresses with proposal power. The whitelist is neat, but that's largely a social mechanism. And so the first two are still, I think, the most critical ones for the protocol. If you cannot call yourself a true DeFi protocol that has governance unless you have completely on-chain control of all the code and all the contracts that make up that system and make it accessible to anyone to come and change about that system without asking anyone else for permission. That to me is the core tenet here. So lowering the proposal threshold from 65,000 to 25,000 materially doesn't change the risk of the system. The quorum, the number of votes required to actually get a proposal to succeed, is remaining the same. Folks, could actually argue to raise that number as well. But the system should be more accessible to a larger populace to make those proposals. Not everyone is as fortunate to me to, while I have a large percentage of my net worth in Compound, I don't actually have, the 75,000 votes that, we have on the platform. We're lucky enough to have, some folks who have those tokens that are, willing to delegate to us who, since we pay a lot of attention to the protocol.
Gotcha. Yes. Prop 89 really just increased like the decentralization and inclusivity of the protocol. So just for the sake of time, I guess we'll kind of speed through this next slide here just on grants. Is there a date yet related to when the new grant program will be back?
No, I mean, I think it's a matter of a personnel problem, essentially. You just need someone to come in and run it. And that person, if someone's listening out here, listening to the recording, is interested in trying to run a grants program for a protocol and might have some experience applicable to it, do come to the forum, write a forum post, make your argument that you should do it. You can get paid quite handsomely to do this. This is by no means a side gig. Uniswap employs a team for their grants program, and so do other protocols, and they all get paid quite handsomely. So I think it's really just a personnel problem at this point. Everyone's for it, but no one has the time or the bandwidth or for the compensation that's being discussed.
Cool.
Yeah, just a couple last points kind of as it relates to the roadmap a little bit. If you could maybe share some details on where we're at as it relates to the multi-chain strategy, and then lastly, I know there are some limited details out there about Compound 3, but maybe if you could kind of share what you can, what you know, and your general your outlook on both of those.
Yeah, absolutely. So I don't have any proprietary information, so I'll say that first. I'm just, for all intents and purposes, a community member, and I know for a fact that really largely all the VCs are in the same boat. The labs team, who's the core engineers behind the protocol, does a very good job not telling anyone anything. And so what we do know is really just the public information. So they've done 2 developer calls in recent time where they discussed Compound 3 with folks. Generally, it's a much slimmed down version of the protocol instead of the generalized money market right now where folks can deposit and borrow anything on either end. It's you're supplying a thing as collateral and you're only borrowing USDC or whatever that reserve asset is. So the first version, as they've told everyone, is going to be USDC as the reserve asset. In theory, that reserve asset could be anything else, which makes the system a bit interesting. You could have a bunch of little versions of Compound 3, these like little silos where you could have one that's flavored to ETH, where you're depositing a bunch of ETH derivatives and only borrowing ETH as the reserve. You could be depositing a bunch of wrapped Bitcoin derivatives and borrowing only wrapped Bitcoin as the reserve. All sorts of fun things could be done with this, and I think that's kind of like where they're going with it. A bit more of a gas efficient, simpler protocol to swallow, and just generally more efficient. Like all the original smart contracts at this point are well over, I think, 2 years, or not well over, maybe just about 2 years. And so that's like the other main component here, making it easier to deploy and run on the other chains. So frankly, though, we don't have a ton of information as far as timeline goes in development. We know what they've stated is that there is the plan to post the open source version of the protocol in late April here. So maybe this week, maybe next week. I'm not holding my breath, maybe a couple weeks after that. And then we'll get a testnet version of it, the following month. The code is going to go to audit to OpenZeppelin, and OpenZeppelin is the formal audit partner of the protocol. So I think they're putting on, the final, finishes of that, and it's going to be going to opens up in here in the next few weeks. So I've heard through the grapevine. And then we'll kind of go for there. So, I think everyone's kind of hoping for a mainnet launch in, July or something, or June. But everyone, like, keep a massive grain of salt with everything I said, because this is coming through about like 30 minutes worth of like 2 different conversations, and everything is subject to change. And I don't know anything really in reality. So we'll see what comes. I think everyone's excited.
Yeah, that sounds great. Yeah, I was able to catch some of those calls, and yeah, it does sound like, main or testnet is supposed to kick off shortly. So I'm sure everyone's pretty excited about that. And real quick, it seems like the development's been a little different as it relates to the multi-chain strategy. I know the initial idea was to kind of go with that like Starport integration, and seems like there were some development hiccups, and as the landscape kind of developed over DeFi and multi-chain strategies, and some compromised platforms, it sounds like they were kind of trying to pivot to a different model. You able to maybe touch on that a little bit?
Yeah, I don't know much. I think the general idea was like, let's make the code simple, and let's make it easy to deploy and easy to manage. There have been hints at additional tools to help manage all these different deployments, and some new testing tools throughout these protocols. It's been discussed that the new Oracle solution that the protocol is going to go with is just going to be directly Chainlink, which is advantageous for all the different chain deployments where there isn't necessarily robust on-chain liquidity that exists on Ethereum. But largely, I think it's, largely we don't know. But again, there's a lot of guessing work going on right now. So I think we'll find out in the next few weeks here a lot more information. And then, even so, have the product in the next couple of months, and it should be a fun summer.
Yeah, sounds good. Something to look forward to. I don't know if Sami, if you had any other questions on our end. We're pretty much rounding the hour here, so I think the questions from the community have been submitted, and I think we've kind of touched base on that. So if any other viewers have any questions, please feel free to throw them down. Otherwise, it's been a good time. I've really enjoyed having you and hearing all your insight.
Yeah, for folks who are interested in following along with Compound in general, there's the forum at Compound .xyz. There's the governance action forum on Compound Finance. You can check out the proposals that exist there. Do join the Discord Discord as well. There's a developer call that exists every Wednesday in the morning. Well, every other Wednesday, and then on the other Wednesdays that isn't the Compound Lab developer call, I tend to run a community call on Twitter that's a bit more casual than the formal developer call. And then in general, for folks who are interested in following, GFX Labs and our interesting governance on Uniswap, MakerDAO, and Compound, and the other awesome products that we're developing over here, which is in fact what really I spend most of my time on, believe it or not. Do check out GFX Labs and Poppy Finance and Etherlands, or all the rest of our main projects.
Awesome. Yeah. Well, thanks again, Sami. Thanks for joining as well. I hope everyone has a beautiful weekend, and we'll do this again next time.
Yeah, this was fun.
Right.
Thanks, everyone.
Yeah, thanks for having me. Cheers.
All right. See you.